Welcome to Beyond the Lens, where history comes alive, and every documentary takes you deeper than ever before. History isn't just written in books. It's carved into ancient ruins, hidden beneath the oceans. For breathtaking this is a journey beyond the lens. History
Think of the largest companies on Earth: Apple, Microsoft, Amazon, Coca-Cola, Tesla. Behind these ubiquitous brands, you'll find significant investments from a single institution. That institution manages over $13 trillion in assets. To put that number in perspective, it makes them the largest financial entity of their kind in human history. Yet they don't manufacture smartphones or build electric cars. They sell no coffee and manufacture no goods. They operate entirely behind the scenes of the global economy. This combination of massive scale and a low public profile has fueled a viral internet theory, the belief that BlackRock secretly owns and controls the entire world. Looking past the conspiracy theories reveals a truth that is far more mechanical. To understand how they actually wield power, we have to look at the rigid rules of modern finance. When you strip away the dramatic perception of a shadowy global cabal, you find a highly structured, data-driven operation. BlackRock was founded in 1988 by Larry Fink and a small team with a specific mandate. Their goal was to build a team that could understand and manage financial risk better than anyone else. Over the following decades, they grew rapidly. But to understand that growth, we must distinguish between the management of wealth and the actual ownership of it. As an asset manager, BlackRock functions differently than a private hedge fund. They don't invest their own corporate capital. They manage the capital of others. Imagine millions of everyday people and institutions pooling their capital together to invest more efficiently. BlackRock acts as the custodian. They direct the money, but it legally belongs to the investors. That $13 trillion represents pensions, endowments, and retirement accounts. Ultimately, that total is a measure of the public money BlackRock has been trusted to guard. A massive portion of that public money is directed into low-cost index funds and ETFs, specifically through the iShares brand. When a client buys an S&P 500 ETF, BlackRock automatically buys fractional shares in all 500 companies on their behalf. Managing index funds for millions means holding minority stakes in thousands of companies simultaneously, a mathematical requirement, not a monopoly. They appear on major shareholder lists because they track the entire market, not because they have staged a hostile corporate takeover. To find the true source of BlackRock's influence, we have to look past the money and into the software they built. Their proprietary technology platform, known as Aladdin, was designed to analyze massive portfolios and monitor global financial risk in real time. External banks, competing insurers, and massive pension funds all pay for access to this technology to support their own investment decisions and risk management. By providing the data platform that its own competitors use to measure risk, BlackRock exerts a level of influence over the global market that arguably carries more weight than the capital itself. This scale attracts intense scrutiny from regulators and economists. They aren't looking for secret plots. They are analyzing the mechanical consequences of this much concentration. Because BlackRock holds so many shares on behalf of its clients, the firm is granted the collective shareholder voting power attached to those investments. This aggregated voting power allows them to weigh in on corporate governance, the election of board members, and company policies across the entire global market. The real debate in modern finance is whether any single manager should be allowed to wield this much concentrated leverage over thousands of public companies. This concentration of proxy voting power is the central issue for regulators, representing a far more complex reality than simple ownership of the world. Conclusively, the data shows that BlackRock does not secretly control the globe. They are the largest and most efficient manager of other people's money in history. The firm represents the logical outcome of a global financial system designed for technology, scale, and the massive pooling of public wealth. Deciphering how BlackRock operates doesn't expose a conspiracy. It provides the financial literacy needed to understand the machinery of the modern world. If you look at the shareholder records for the largest public companies on Earth, one name constantly appears at the very top: BlackRock. This omnipresence fuels a common belief that the firm somehow owns the world. In reality, their growth came from institutionalizing a logic that the rest of Wall Street largely ignored. To see how, we have to look back to the mid-1980s. Trading floors were loud, chaotic, and driven by a singular obsession: guessing what the market would do next to maximize short-term profits. Traders placed massive bets on the future while lacking systems to calculate their actual exposure. The financial system was moving blindly, oblivious to the dangers accumulating in its own portfolios. Without a way to quantify that risk, the system had no way to prepare for a shock. One significant miscalculation could, and eventually would, bring the whole structure down. One of the people operating in that environment was a rising star at First Boston named Larry Fink. Fink was highly successful, building a mortgage-backed securities division that brought massive profits into the firm. Then, the systems failed him. Following a single mistaken interest rate prediction, his division suddenly suffered massive losses, reportedly exceeding $100 million. The shock of that loss forced a deep realization. Trying to outsmart or predict the movements of complex, unpredictable markets was a guaranteed way to eventually fail. He decided that the industry needed a reversed approach. Instead of trying to guess what might go right, a truly resilient firm needed to build systems that could measure exactly what could go wrong long before disaster struck. After the loss, Fink left First Boston with a ruined reputation. He used the following years to design a new framework for finance, centered on the very risk that had cost him his career. In 1988, Fink and 7 partners launched a small startup called BlackRock. Their pitch to the market was distinct. They weren't promising clients the highest possible returns. Instead, they offered rigorous, disciplined risk management. Throughout the 1990s, this approach began to attract massive institutional clients. Large pension funds, major universities, and national governments started handing over their capital. These organizations prioritized safety above all else and needed highly technical experts to untangle investments that were growing more complex by the day. By focusing intensely on the prevention of loss rather than the sheer pursuit of profit, BlackRock quietly positioned itself as the trusted manager for the world's most cautious and powerful pools of capital. 2 decades later, the global financial system nearly collapsed. The housing market crashed, taking massive financial institutions down with it. When Lehman Brothers failed in the fall of 2008, a wave of sheer panic ripped through the global economy. Traditional banks were collapsing because they had accumulated massive hidden exposures to toxic mortgages. But BlackRock systems were explicitly designed for this, mapping out those exact vulnerabilities, allowing them to navigate the chaos while others folded. As the damage spread, desperate governments and central banks realized they lacked the tools to value the toxic assets decaying on their balance sheets. They were forced to hire BlackRock to analyze and manage those distressed global portfolios. When the 2008 crisis subsided, BlackRock emerged as a critical advisor to the state. The company now held a unique position as a private firm serving as a primary consultant to the global financial authorities. Right on the heels of the crisis, in 2009, BlackRock acquired Barclays Global Investors and its iShares division, triggering a period of massive growth. The crown jewel of that acquisition was the Exchange Traded Fund, or ETF, a financial vehicle that would effectively democratize their philosophy of risk. When you bet your money on a single stock, you are exposed to extreme volatility. An ETF solves this by bundling thousands of stocks into one stable basket, allowing everyday investors safe, diversified exposure to the global market. As millions of individual investors shifted their retirement savings into these specific funds, BlackRock's total assets under management began to multiply at a staggering rate. By successfully packaging diversified risk and selling it directly to the masses, they scaled their operation from managing millions of dollars to managing trillions. Today, BlackRock sits as the largest asset manager in history, operating investment platforms that span virtually every major market on the globe. This scale brings us back to the public misconception that they own the world. The vital truth is that BlackRock does not actually own those trillions of dollars in assets. The everyday investors, pensioners, and institutions do. Understanding this strict legal distinction between managing capital and owning it is the only way to comprehend how this empire actually operates without breaking the law. The ETF boom created a massive unintended consequence. Because millions park their money in BlackRock's funds, they hold the proxy voting power for those shares.
This gives the firm enormous leverage over the largest public companies, influencing executive pay, boards, and environmental policies. This dynamic has triggered intense global scrutiny, raising the question of whether any single private entity should hold this much concentrated, centralized influence. The firm maintains that its stewardship is strictly intended to protect the long-term financial interests of its clients. But critics continue to debate whether that defense justifies the sheer weight of their scale. It leaves us with a fascinating paradox. By successfully democratizing investing and protecting the masses from financial danger, BlackRock accidentally consolidated enough corporate power that they are now viewed by many as a potential systemic risk themselves.